Um, how are you guys? And you can hear me, see my screen? Is that all good? Okay, just making sure it's all there. Okay, so um, I was just busy thinking about something here as well. That's all good. That's all good. Okay, so the first thing we want to do, let's have a look and just see which kind of news events are coming out this week for day trading. So I'm going to do a day trading, end of day trading type of setup here. So first of all, I'm just going to go to Forex Factory and have a look at the calendar for the week ahead. And this is it. Okay, so we've got non-farm jobs numbers out of the US. ADP though, so that it gives you a sample size. Um, they expect to have a big jump. This is interesting. That's not normally such a big jump. This is interesting because normally the jobs have been kind of disappointing. If we just kind of go have a look at the stuff over here. That's my thing. Come on. Okay, my taskbar is getting in the way. La la la. Um, Give me a second. Huh, here we go. All right, cool. So let's just have a look here a little bit closer. And actually, they've like it's been shrinking and they've been underperforming. And this time around, they're expecting a big jump. Now, I mention this because uh, this is a gutsy thing to say. Either they're going to do well or they're going to fail. So if it's less than this, there's going to be quite a big shock to the market. Um, anyway, and then we've got PMI, which is we'll have a look at see if it's below 50, then it's bad. Obviously, there's shrinking. The purchasing orders are shrinking, but if it's above 50, it's okay. Unemployment is big. They'll be looking expecting those to increase. So if you kind of again, if you go have a look here, it's kind of the new normal at the moment. Go look at this, and for the most part, they're starting to climb a little bit. You want to pay attention to the revision. The revision is quite important because they're revising stuff a lot lately. Like it's not normal. It's okay to get your numbers to for estimates and then to have to update them, but normally they're quite close to each other, if not exactly in the right place. And now what's happening is the revised numbers versus the forecast is generally not looking so good. Okay, so for the most part, it's worse. So that's why you're seeing the higher numbers. Anyhow, that being said, so there's quite a bit of US news coming out. There's also non-farm supposedly on Friday, unemployment stuff here. So just pay attention to that. To that, if I do that in Singapore time, give me. And I apologize. Here, let me do that like this. So if I do it for you guys, that's 9:30 in the evening. So you want to make sure that you probably, if you're going to place some orders before you go to bed, which actually you guys don't have to, then you would do it obviously either well before the news on the higher time frame or after that. Okay, just be prepared for that stuff. Make sure you got your stop losses tightened up. Make sure you guys are taking profits sooner at the moment. If anything, guys, this craziness and instability we're seeing is just increasing. Like we're like, are we? Is this World War III? Is this the start of World War III? Like, it's absolutely crazy and it's not going to stop anytime soon. I think we might see changes before the end of the year, but I think it's going to get worse before it gets better. Anyway, that being said, this is one thing I really want you guys to do to watch when the market opens on Monday is to have a look and see if there's a gap or not as a result of the war, the attacks on Iran. If the markets don't gap very much, including currencies like the dollar against the euro or whatever, if they don't gap very much and the futures markets, the cash markets for the S&P and the Dow, if they don't gap a lot or at all, then that is a really important sign of the times. It kind of just shows that this crazy is just accepted by the markets as the new normal. We're also in a bit of a bubble. But if we do see a big gap, like something really, like on the daily, it's, as big as a daily bar, then, it's quite a bit of a shock to the markets. But the US were talking about how they were going to invade Iran for a couple of weeks now. They've been looking for a reason to do it. They don't even know why they're doing it. It's just creating a wall for the sake of it. It's just ridiculous. So anyway, that being said, that's what I want you to have a look at in the markets to see what's going on. Now, We're going to go to the daily time frame, and what we're going to do is purely just look to see which chart markets are trending or which aren't, where the opportunities are. We're going to run through this entire thing. So this will be higher time frame stuff. And then you can see the process. So all I have on my screen for those of you who are new, hi Jackie, how you doing? Gary, I remember you as well. Jack, you as well. I got you guys. Sukuni as well. Hello, guys. I've got the 200, 50, 20, and 10. Now, the most important ones are the 50, 20, and 10. It's just moving average geometry. This is the shorter term, so the 10 and 20 together is the shorter term average of price. The 50 is the medium term. The 200 we don't really need, but I've got it on there anyway, but it's the longer term average of price. So when you see them all in the correct order, like that, you've got them all in the correct order. If you've got a nice angle going up or a nice angle going down, and you have them with a nice little gap between the levels, that's also quite cool. If you do have that, all of that just tells you that the trend is quite established. So what you can see from this one, of course, is that they're all in that order. And we could see they're heading up. We've got price producing high lows, higher highs. Now, the first thing that you should always look at, guys, when you look at a chart, is you should always look at the candlesticks, the price action. That's the first thing you should have a look at. So let me create a version of this so that I can show you. So let's say I create another chart here and just get rid of these other things. You don't need this other stuff, but I want you to see the difference. You don't need these things. But you do need price action. You do need to know that. Okay, so I'm going to keep this up because we'll come back to it every now and again. This is the important stuff. You really need to be paying attention to that. So the first thing you look at when you get to a chart would be the price action. So let's just say that we look at euro dollar here. Here you can see we've got some lower highs coming in. We're looking at it now because what it's doing now gives us a clue as to what it's going to do. Remember, we've only got to get an idea of what the next 5 days, the next 5 candles are going to probably do. That's all we have to do. So you can see here that the last, excuse me, last week and a half have done almost nothing. Okay, so that's why I'm curious to see what happens with this. If anything, if this war triggers anything, if it weakens the dollar, we'll have to have a look and see. But we're only trying to guess what the next 5 candles on the daily are most likely going to do. And it's much easier for us, guys, if the market is moving. So if the market is going up, it takes a lot of energy to move a market. So if a market is trending up, producing high lows, high highs, it's much more likely to keep doing that than it is to potentially do change every week. It doesn't make sense for it to change every week. Unless it shows signs of changing. So you can kind of see it possibly doing that, then yes, this week it's probably going to go down a bit. So right now the problem we have is that we're going from here to here to here to here to there. We don't really actually have a trend. Here we had a very nice trend. Over that point we did. We don't really have anything here. So it's actually very difficult to predict what it is likely to do, which actually is the same thing as saying it's probably not going to do a lot. Like it's not going to suddenly start trending beautifully because we only have to predict this many bars. That's all we have to do. So we want to focus on the charts we're predicting what it's going to do. It most likely going to do is much easier. So what's going on with euro dollar? It's caught in the moving averages. And therefore, we don't think a lot's going to happen. If you look at it over here, it's not giving a lot of clarity. If we have a look at GBP USD, what's going on? Well, GBP USD is in a bit of a downtrend here, lower highs, lower lows, but it's been going sideways for 6, 7 days. Okay, it's in exactly the same place it's been in for the last week. So what we are looking for this week is, are we going to break down, which is where the kind of prevailing or most recent trend is, or is it going to reverse and it's going to go up this way? Okay, that's really what we want to know. Or is it just going to stay here? Is that going to be the next 5 days? And it can only be one of those 3 things. Only one of those 3 things. So we want to be watching the lows. We go to Aussie dollar, US dollar. Now this is slightly different. Slightly different. Why? Well, because this one actually is generally climbing higher. It's actually producing a series of higher lows and higher highs. And even if we look at the most recent bars, we've kind of still got this one actually climbing. It's very subtle, and this was a mess. That's a hot mess as well, but it is actually climbing. So Aussie dollar, US dollar is the first chart that's actually showing a bit of direction, even if it's choppy and slow, but it is moving to the upside. Is everyone with me so far, yes or no? Is everyone with me so far, yes or no? So far, does this make sense? If we then go and look at this version with the moving averages, you can see, look how the moving average is all fanning out. Look at the 200, the 50, the 20, and the 10. So there's definitely a flow of price. You've got to think about it as like a stream. It's just a flow of price. So this one actually has some potential. We can tell that Aussie dollar, US dollar is actually kind of trending. And which way is it going? It's most likely going up. There might be a little bit of resistance here, but for the most part, it should continue up. My advice to you guys is wait to see how the first half of Monday goes because it's going to possibly gap. And then you want to see if it gaps and keeps going away from the gap or if it gaps and then comes back to close the gap. And if it comes back to close the gap, it's probably fine. The meaning the market is not in a panic. It's like it's not bolting and running. It's you know what? It's actually stopped and it's like coming back. It's like so it's probably not panicking. So we go to Kiwi dollar. This one is a little bit more messed up as well. Here's the high. This is the first thing you do. Forget about anything else. Don't look here. Okay, don't look there. This is what you need to be doing. So you need to look at what price action is doing. Imagine it like this. If you're in your car, this is what you see through your windscreen. That is the roads and the other cars on the road, and the squirrels and the dogs and the cats and the traffic lights and the robots, the traffic lights, robots in South Africa. Anyway, and then the circles and the roundabouts and so on. And then if you look down at your dashboard and you have your petrol gauge or your fuel gauge and your clock and your temperature, your thermometer, and your speed, that's what you see here. That's what this is. So you can drive without this. If I block this out, you guys could go ahead and drive without it just fine, but you can't drive if I block that out. Okay, so you must understand this is the most important stuff you see. This stuff is only secondary. You only look at it at a specific time for a specific reason, just like you do in your car. You look down at your speed or at your petrol gauge, only every now and again to check things. That's all. So not really liking that. So far, Aussie dollar being the only one that's showing some kind of a direction to it. Kiwi yen, also a little bit messed up. If I zoom out, you can see that overall it's been going up. But if you look at it now, so imagine something that was trending beautifully, looks good, suddenly does this. Then you know it's lost, whatever was going on there is gone. And that's kind of what's happening now. We've gone from this down to here, to there, to a higher low, to a little bit of a kind of an uptrend here, but it's still doing that. Okay, so dollar yen is stuck in a little bit of a place at the moment. So if you get a situation like this and you want to understand what's going on, it's a good idea to go up the time frames, zoom out and see what's going on. So what do we see? Well, we could see, okay, there's definitely some form of a level here. And the 200, 50, 20, and 10 are all going up, which means the kind of the flow of price is still heading up. And this is a mess. The last 1, 2, 3, 4, 5 weeks, it's just been sideways. Okay. Then you go to the monthly and get a sense of what's going on. And then the monthly gives you a bit of clarity. The monthly is showing you for sure that it's all trending up, but also the last 4 months have been side by side. So guys, again, no traders, beginner or professional, seasoned traders can make money in dollar yen in conditions like this. Maybe an algo can because it's just noise. But the last 4 months it's been sideways. The last 5 weeks it's been sideways. The last few days and here it's been like it went sideways here for 4 days, then up, then sideways. So you can't trade stuff like this. You can't. If you go down to the lower time frames, you just get that. And you can't trade that. But it is leaning to the upside. It's a very strange thing, but it is looking a little bit more bullish here. It's kind of trending up overall. It's got higher lows, higher highs here. The general flow is to the upside. The weekly chart is a bit of a mess here, but it's basically what it tried to do was it pulled back to here, then it tried to go up, then it came down, now it's trying to go back up again. So there's a bit of a battle going on, but it's just a little bit more bullish than bearish. Right, then we got dollar Swissy. Dollar Swissy is going down. But again, last five weeks, 5 weeks sideways. If you go to the monthly, you can see it's going down. You can see it heading lower, but you need a little bit of perspective here. How much history we got? Okay. So there's a level that we've broken through up there. There's another level that we're heading down towards here. So that's kind of where we're stuck. And this, I don't think this was the last time it was this low. And this is the only time in history or since I've been checking the foreign exchange market that it's been this low. But that kind of appears to be where it's going. But again, also you could see it's doing it in a very sluggish fashion. All right. For a monthly chart, that's what it's done here. 1, 2, 3, 4, 5, 6, 7, and then 8, 9. 9 months, it's hardly moved. So just again, this is one of the situations where you could see where it's going, but it's really difficult to make money from it because it's not trending in a very nice way. So at least this one we have direction there. Okay, and again here, look at the daily. Look at the little prickliness, the spikes top and bottom all along here. It just means it's a mess. And again, this one's also messing up its highs and lows. Goes to there, but then it goes to here, but then it goes to there, to there, to there. So it's also forming a bit of a wedge. So we've seen a lot of charts are forming a bit of a wedge. A lot of them, Kiwi dollar, dollar yen, dollar Swissy, euro dollar, they're all forming some form of a wedge. And the one thing they all have in common is the US dollar. So we're expecting at some point very soon, some point probably within the next week or two, we would expect it to be a breakout. Because why? Because the pressure's building up. So we expect it to be a breakout. Maybe it'll be this wall. Maybe it'll be the wall. Who knows? But we're expecting it. Okay, dollar CAD. So dollar CAD is sitting actually at a very interesting point here. It's got a nice little level up there. Is actually the level there. And this is interestingly this has got high lows going into this. It might work its way towards a bit of a move to the upside. It's also a bit of a mess. So this is the problem. The dollar is the biggest mover, guys. This is the weekly chart. The dollar is like the biggest mover of the majors. Most of the time, all of them really move against the dollar. So the first thing you want to do is you need to know that. Like when I started trading, I was in London and they were saying, oh, look, it's euro dollar and GBP dollar. And we never thought about the dollar. We just thought about, oh, the pound is strong or the euro is strong. But actually, excuse me, knowing what I know now, the dollar is so big that actually that's the only thing that you need to know. Is the dollar strong or weak or what's happening? Because if it's strong, then you would be going, euro dollar will go down and GBP dollar will go down and dollar Sing will go up. So if we go look at dollar Sing for the most part here looks very similar to dollar Swissy. Very similar. Why? Because it's the dollar that's predominantly driving this. Okay, it's the dollar that for the most part is driving stuff. There's a bit of a level here we want to be a bit careful about, but the pressure is more to the downside at the moment. And also it's not very, it's quite choppy. Look at that. You've also got this. High to there, lower high, higher low, lower high, higher low so far. So also have a bit of a wedge forming here. And sometimes, guys, the clue in the wedge is which side it's leaning to more. So it's not always the case, but when a wedge is like this, then it actually means it could go either way because it's exactly in the middle. If the wedge is more like this, it usually means that the pressure is more to the downside. So in this particular case, we're leaning this way. It's not guaranteed, but there's a bigger chance, like 60-40, that it's going to break down. Just like with some of the other ones, it was leaning to the upside. Okay, long story short, any of the dollar pairs are a little bit tricky here to trade. The other thing is, don't worry so much about the dollar. What it does is more important in currencies than it is against gold, than it is against the stock market. Okay, so if you've heard, oh, well, a weak dollar does this to the stock market or a strong dollar does this, ignore it, ignore it. We are much more likely to see the impact of a stronger or weaker dollar in the currency markets than we are in the commodity markets or the stock market. So just let it go. You can have a weak dollar and a strong stock market, and gold can be going through the roof. You can have a strong dollar and a strong stock market, and the gold can be going through the roof. So there is no rule that binds a strong dollar or weak dollar to the stock market or to commodities. Okay, so just forget that. But it does impact the currency markets. Okay, does that make sense? Right. Okay. Let's move on and have a look at all the currency pairs. We're going to go through those quickly. Oh, well, that's great. So you can't all see the question, but I'm going to show it to you now because it's such a good question. Um, just so you can see what it is. Looks like this. Okay, so given the Middle East war, what is your take on gold, Aussie dollar, S&P 500? So, very easy answer for this one. There's a complete correlation between silver and gold going up and all the geopolitical uncertainty. It makes complete sense. The last time that this happened, that we saw a massive rise on those, the last time we saw a rise like that was, how much history have I got? Oh, I do. Cool. Just checking. The last time I saw a rise like this was here, there, which was when 2007, 2009. 2007, 2009, global financial crisis, it breaks through that $1,000 level, breaks through $1,000, goes from 3 digits to 4 digits, massive. And the last time we saw that was that move towards instability. The whole world is kind of melting down. Global financial crisis moves towards gold. We see a breakthrough and then it kicks off a bubble. Same thing now. All of this is tied completely to global uncertainty. The dollar, so this is how it would go. Normally, the dollar, the Swiss franc, the Japanese yen, and gold would be your kind of safe havens. Why? Well, because the Swiss are generally politically neutral and stable. Their policies don't change generally, and therefore holding stuff in Swiss francs tends to retain its value. The Japanese yen, that's a whole other story, but again, they tended to have a fixed policy for the last 30, 40, 50 years, low interest rates. And so what happened was that because of the fixed low interest rates, the yen became the basis for borrowing, which was, I don't think it was intentional, but they figured it would make them quite stable, but it's had other. Now the problem is that the other part of that equation, which is the US, has become unstable. So then the dollar would become the primary world's reserve currency and safe haven. Now, you would want to hold your debts in dollars. So if someone said to you, look, you lent me $1,000, I can pay you back. Or here I can give you a receipt that says I owe you the money, and it says I owe you the money in coconuts, or I owe you the money in US dollars. Someone will say, you know what, I'll take the US dollars because I don't know, like I know that's going to hold its worth. And so the countries, other countries outside the world have opted to hold their debts in US dollars for that reason. But now things are changing. Everyone's like, I'm not sure that I want US dollars anymore. It's still the most liquid, but there is something different now. So you are seeing a movement away from that. And so what's left over is gold, right? So if the whole world is going to go towards another global crisis, gold is, they're just getting there now. They're just getting sooner. Like we learned what happened in 2007, 2008. Let's just go straight towards gold. And so because of all the geopolitical uncertainty, it's the one thing that all the countries can agree on. If you're not sure about the dollar, you're pretty sure gold is the universal kind of thing. So that's what's happening. So it's still in a bubble. It's gone parabolic. It's still going. So the bubble hasn't burst yet. The bubble is still intact. How do we know this? Well, I was going to get to gold, so I'll get to gold later and then I'll take you through it. But the bubble's still intact. So with the Middle East crisis, it's just part of the same thing. It's just part of the same global uncertainty. So it's going to drive gold this week is on my list. So it's just going to add to that. The Aussie dollar, there is some interesting correlation between the Aussie dollar and gold. There just is. There's a bit of a tie between oil and CAD and gold and Aussie dollar. So there's a little bit of a correlation between that. And so I would expect it to continue to strengthen. If it is, that would be the reason why predominantly. And the S&P 500 is a very interesting thing. There's a lot to actually talk about that. So that one is slightly different. Predominantly, I still expect the markets to continue to climb. I still expect them to climb for most of 2026. You'd have to because they've still got a lot of, they're really big. They're massive markets. And actually, despite all the bad news coming out, the markets are driven predominantly by spare cash. Let me talk about that when we get to that. So just to answer this question to where I am so far, gold's still in a bubble. It's going to keep going up. More geopolitical uncertainty is just going to keep driving it up. Aussie dollar is I think is benefiting a little bit from that, so I think it will also get pushed to the upside. And this one we'll talk about in a moment. It's a bit of a mixed bag. Okay, it's a little bit I still lean upside, but it is very choppy and it's not impossible. It could take a bit of a hit, but we'll see. Okay, right. So let's carry on with this, guys. You're doing very well. I'm proud of you. Let's have a look. We're going to run through all these pairs here. Okay, so the best thing to do is to kind of broadly just look at them on the weekly. So we go here onto the weekly, go look at euro yen. It's generally climbing up. This is a mess because of this whole thing here. So you've got that versus that, and it's just very choppy. The reason for this, very simple. I don't know if I've explained it to you guys, but it's to do with the yen carry trade. So the short version is that because of the low interest rate on the Bank of Japan that's put on the yen, people with lots of money tend to, institutions, hedge funds, banks, wealthy people, they tend to borrow yen because the borrowing rate on that is it's almost nothing. It's nothing. They convert it to dollars and then they buy stocks. So if the stock market goes up 12, 13, 14, 15%, but they only have to pay back 1% on the loan, they just pocket the difference. Excuse me. So a lot of very wealthy people, institutions, hedge funds, so on, have been borrowing Japanese yen for a while. The problem with that is that has also caused them to keep the interest rates low, which also has caused their currency to weaken. Now the problem is that the yen has been weakening for so long now, it's become a problem. Their currency is getting too weak. So they want to raise interest rates, and raising interest rates tends to make borrowing your currency more expensive because it's high interest rates. And so what that could lead to, and this is why Bank of Japan's in a bit of a tough place, is that it could cause people to unwind their positions from the stock market to pay back the yen loans. And in America at the same time, America is dropping its interest rates because they want to keep juicing the stock market, which is a very stupid idea. They don't care about anything else other than keeping the stock market going up. So cutting rates is not going to help people, but it's going to keep the stock market going up, which is mainly wealthy people. So what happens is if your dollar interest rates are going down and your yen rates are going up, it's not worth borrowing the yen, and it's because you're not making that money anymore. So they're going to start unwinding their positions and they're going to start paying back the yen they owe, which is going to cause the US markets to take a bit of a hit, slowly but surely, and the yen can eventually start to get stronger. So what actually happens is Bank of Japan they wanted to go this way because it's been going this way for a very long time. But a lot of people who've got all those positions, who've got all their money invested in that, who are borrowing the yen and who've converted it to dollars and have put in the stock market, they are basically going to hold on until the last minute. So what that means is you can see some people unwinding their positions, but some people are still holding on. So what they're looking at is they're watching the US. Is the US going to cut rates? And is the Bank of Japan going to raise rates? And eventually there'll be a point where like, okay, we're all out. And then you will see a change of trend in the yen pairs, not just dollar yen, but the yen pairs. Okay. So I'm just trying to explain to you why it's very choppy at the moment, why the flow is still trying to go up. And so when you go look at these pairs, it's still trying to go up. If we go across to here, we go to the weekly chart, you can see that for the most part, it's looking beautiful. And it's just pulled back in a nice bullish candle. If we break the high here, it's going back up to the high. So pound yen could be sitting on your watch list for buying opportunities. I'm just trying to explain to you why it's getting a bit twitchy here, because this is now when the Bank of Japan said we're going to raise rates, and they actually started doing it. And so just keep in mind that as America cuts rates and Bank of Japan raises rates, you're going to see all the yen pairs get very choppy and eventually start to go down. Aussie yen. Okay, going up here as well. How many of you guys were in Bali for the traders retreat? How many of you guys were there? You know Julian? Julian's obviously super, super sharp. He's kind of at the very zenith of our collective experience. And he's the guy who talked about the bond markets and interest rates and all the various stuff. So that's why he would know all about that stuff as well. So he's probably one of the most high-level people we get at these events. And we had Kathy Lean there last year. Anyway. So this pushing up a little bit higher looks very, very cool. Look at this. So Aussie, again, strong Aussie, and the Aussie yen going up anyway. So guys, I would really put Aussie yen on your list for that today. So the very first one, so I would keep an eye on Aussie dollar, US dollar plus AUD, JPY. Those are the first two I want you guys to pay attention to this coming week for buying opportunities. Kiwi is not really the same, but it is going to start pushing up. So cautiously, guys, cautiously. When I say cautiously, what I mean is 0.5% risk per trade or less. Don't go in at a full 1%. Make sure that you are taking profit as you go. Because these days the markets are kind of choppy. What I can tell you is more or less the direction where they're going, but they go up and down a lot more than they used to. So what used to happen in other years is that the lower time frame would kind of trade like this, Whereas now it's a little bit more, it's more like this. And so it just makes trading much more choppy. Okay, so just be prepared for that. CAD Gen. So again, CAD Gen is pushing up. So all the yen pairs are still wanting to go to the upside. There's still a lot more pressure. Some of them have got some levels they're going into. It's just all I'm saying here is it's possible that we could see the yen pairs keep going for a couple more months, which means that's why we do this every week, is this week you might have opportunities on those to the upside. Look at that as well. Also, so CAD Yen, Swiss yen I really like. So Swiss yen is on the list. I like that one as well. Okay, have a look at those. Euro GBP. Not really a fan of this for the following reason. If you look at it from a monthly perspective, what happens? It's ping-ponging since Brexit. Interesting. Uh, and although it is a little bit bullish, it's also incredibly choppy, guys. So honestly, I think you can live without it. Then we get to Euro Aussie. And what do we have? Okay, we've overextended to the downside a little bit. But you know what? The behavior here, again, this is where it gets a bit tricky. This one is a tricky one because this daily trend is beautiful. Um, excuse me, it's the kind of thing we really, really do want to trade. But I do think it's getting ready to pull back a bit, more because of that weekly chart. Like at some point, this has to kind of, let's just do this quickly. At some point, I'm expecting this, if I just mark all these levels, at some point, we've either got to go from here to there and carry on. Oops, I didn't mean to do that one. That was a, we go from there down or up to there down at some point because we've quite overextended now. Excuse me. And that's my only concern. That's my only concern. And that's why you can see it battling where it is now, because that level, it's starting to run out of steam. The other thing that's showing up now, and I don't know if you guys know this, if you've been taught this, but when a market, it's going to be similar. Paul, it's going to be similar to this. Pound Aussie. We can go straight to Pound Aussie, and then you could compare the two. Sorry, guys. Didn't mean to cough in your ear. So when you get a bit overextended and this time frame is starting to get ready to pull back, which it should do off a key level. Could it go through here and go down to this level? It's possible. It's possible. But it could also turn where it is now. We know that eventually it's going to pull back. And we just don't know if it's going to be off this level or this level or that we don't know that. One of these two levels. But when it does do that, when it starts slowing down, when this starts slowing down and it gets ready to pull back, you will see divergence on the lower time frame. So when you go to the daily, what starts to happen is you start to see divergence because it starts slowing down before it goes up. And so here you start to see between those lows, you start to see it going up. Here you're starting to see divergence already. But yeah, that is essentially something that it's showing us here that it's likely to kind of start going sideways. So B, this is really the kind of chart I really want you guys to trade, but I'm concerned that it's getting ready to start to pull back on the weekly. So that means that on the weekly here, you would have a pullback from where you are here to, back into the moving averages. So on the daily, it would be a bit of maybe a pullback here. So just exercise some caution in this case. Keep an eye on that. But yeah, at some point we could get something very cool. It could just come back up here and then carry on down. So yeah, long story short, that's my concern. Let's go straight to Euro Aussie. It'll be this Pound Aussie. Sorry, it'll be the same thing. Excuse me. So Pound Aussie is also trending down, not showing too much divergence, but from a weekly perspective, also, there's a level here. So I would say this might want to be able to get through. You can see there's a level right here where it is. That's a level right there. So it's the same dilemma. And this is the one thing that I don't know any seasoned traders. I'd love to ask this question when I get to, this would be the question I would ask when I get a panel of traders, like when I get Paul, Julian, and Kathy, and Chloe, and like all the guys in a room, is ask them if they know when it's overextended, is it gonna turn here or is it gonna turn there? Because it's gonna turn that level. You just don't know which one because it's already very overextended. Why do we say that? Because if you do a move like that, that was the previous move. There was a little bit of a move, and this one is really big. So this is very overextended, just in the same way you had here. And the way up here, like there's a move, there was a move up, there was a move up, and then this one was like really big. Okay. So we don't, it's hard to tell. But when it's overextended like this, at some point it has to take a bit of a breather. It's got to come back. And that's what I'm really kind of looking for. So that's why I want you to exercise some caution. But guys, this is a great trend, man. Looks really, really good. It might want to do one more. So it might actually find this coming week, it pulls back and then does another sell. But in a situation like that, if you take that sell, because this is a great chart, you've got to be prepared. Like you really want to take a bit of money off the table when you're like 1-to-1 or even on the way there. In fact, you know what's interesting? The last few weeks, my guys and I have been trying a system of taking some money off the table at 1/2 to 1. So if you're getting in here and that's your 1-to-1 and you're going that way, so you get triggered in here. We've been taking a little bit of the money off here, day trading, only during the day, and then moving our stop loss up to our entry, which we don't normally do. And actually, that has resulted in fewer losses because from where I am, the US comes online after lunch, like 1:30, they come online. And so we often find in the morning the market does one thing, and then in the afternoon it does another. So we've been like trading very, what's the term? Defensively would be the expression. So it looks amazing. Let's have a quick look at we'll come back to the rest of the Aussie pairs in a moment. Let's finish up. So we finished all the yen pairs. So we know what's going on there. We know, but we've got our favorites out of those. So again, I'm going to say here, I'm going to add Euro Aussie and Pound Aussie, but with caution, as weekly is due a retracement. Okay, let me know that makes sense to you. Let's carry on. So Euro Kiwi. So Euro Kiwi, because the Kiwi itself is not really doing anything, it's not worth your while. This is a daily chart. It's going sideways. It's garbage. Euro Swissy, also garbage. Look at the prickliness here. Why is this? Well, basically, very quick history lesson. If some of you know this already, I apologize. Very quick history lesson. You could see this massive correction here. You can see monthly if you go back. That drop there is the same as the dollar yen one we saw. That dollar yen one, which we saw, if we go over here, we go look there. Dollar yen, dollar Swissy. What is wrong with me? Sorry, guys. Dollar Swissy. Okay, this one. So this little puncture here and this puncture here are the same as that one there and that one there. And basically, historically, the Swiss franc has always been strengthening. It's always been strengthening. And the problem is that eventually they have the opposite problem of Japan. They have tourists and their currency keeps getting stronger. And so it's caused a problem for them. They don't want to be too expensive because they're also an export country. So they also wanted to do it. And basically the market is going, you know what? We would still rather pay more as tourists, but still have the security of your currency. And so they don't care. And so the Swiss National Bank intervened here, and then they depegged their currency. And basically they've messed with their currency so much. And in many cases, they didn't warn people. They didn't warn anyone. I think they thought we're not going to warn you and that'll teach you a lesson. But the end result was that they actually kind of broke the trading of their currency, not the buying and holding of it, but the trading of it, the speculation. So when you look at the market now, when you see this kind of like gappiness and the price action looks funny, it's because there aren't any speculators on this. Nobody is really doing this. You're either an investor buying and holding it, or maybe you're a tourist exchanging money. That's it. There's no speculation. And it's the same with oil, crude oil. When you lose that layer of day-to-day speculation, the price action starts to look very funny. It gets very prickly and it doesn't really have a trend and it doesn't really do much. And that's what's going on with crude oil, which we'll have a look at. Are you guys finding this interesting? Let me know. Okay, good, good. Okay, so you're a CAD. Again, guys, that's your daily chart. This is garbage. You cannot trade this. Nobody can. The pros won't trade it. They're like, I'm not touching that because it's not going anywhere. And the only thing that benefits from stuff like this will be an algo. So algos struggle in trends, but they do really well in sideways markets. They don't cause the sideways markets. They just operate very well in it. They might add to it, but they can't control it. Okay, pound kiwi. Okay, so again, you can see the pressure to the downside here. So the pound is obviously slightly weaker than the euro, relatively speaking, because pound Aussie was trending much more than Euro Aussie. This has got more green candles here than pound Aussie. It's got more red candles. Excuse me. So pound Kiwi here, still not tradable. I'd leave it. Pound Swissy. The pound's weaker, so pound Swiss is going down. Let's have a look at the history here again. So look at the history. It's now just generally at all-time lows here. So the pound, interesting, pay attention to that because also as a tourist, I'm going to Morzine. I'm going to Morzine next week, so we'll be sitting on the border of France and Switzerland as well. Um, is Morzine? It's France. Okay, I thought so. But it's right on the border. Literally, when you go up and you're skiing, you're sitting at one level and not another. Okay, anyway. Pound Swissy, pound CAD. So what are you noticing the last couple of like pound pairs are just generally going down. So the pound is quite weak. If you just generally look at this, pound Aussie going down, pound Kiwi kind of the last few days going down, pound Swissy generally going down, pound CAD generally going down. A bit of a level here. So the pound's a little bit weak, but it's not great to trade. Honestly, the ones I've given you so far, the best ones so far. Let's have a look at Aussie Kiwi. Aussie Kiwi trending to the upside because again the Aussie is stronger than the Kiwi, relatively speaking. Look at that trend. Look at that trend. So right now there's something going on with the Aussie. It looks like a relative. I want to say it looks like a safe bet compared to a lot of other stuff out there. So I'm going to put Aussie Kiwi on the list. You guys need to be recording this somewhere, writing it down. Is anyone using Notion? Anyone at all using the Notion app? The reason I ask is because it can transcribe what I say and then it can output notes and it can just like it'll give you a set of notes at the end of the thing. It's pretty cool. Anyhow, Aussie Swissie's climbing up a bit, but again, look at that choppiness. I wouldn't touch that. I wouldn't touch that. Okay, Aussie CAD. Also, it is going up. Again, it's the same thing. It's going up, but it's also a bit just choppy. It's not as bad as Aussie Swissy. Not as good as Aussie Kiwi. See the difference? So again, trade Aussie CAD if you want, but cautiously and with wider stops. Because it's choppy like this, you need a wider stop loss. And look, ideally, guys, we want our reward to risk to be 2 to 1 or 3 to 1 as often as possible. So we want that to be the case. But when you're trading something choppy, you don't have that luxury. You don't have that luxury. So you have to have a closer stop loss and a closer target and a wider stop loss because it's choppy. So if it's nice and smooth, like a stock or whatever, or an index, it's beautiful. But if it's doing this, you need to just take profit sooner and have a wider stop loss. So your reward to risk is usually like 1 to 1 in a situation like this and not 2 to 1 or 3 to 1. Can you know the 4 timeframes for the moving average indicator? This is the 10, 20, 50, 200, right? Simple. And they're just simple. You don't need, let me explain why I use simple. And let me know if I'm answering your question, Gary. I use simple. It's interesting. Some people like to use exponential because they feel that it's more responsive to the price action. I prefer the opposite. I don't want my moving averages to get made choppy because of a bit of noise in the markets. I want them to stay steady. I want them to be undisturbed by the noise. I want them to kind of see through the noise and keep going. So I prefer simple. So simple is straightforward. It's very old-fashioned. All of the traders who were learning to trade in the 70s and 80s when it was, computers weren't even on your desktop until the late 90s. So they were doing all that stuff. They were learning price action and they were drawing the moving averages by hand. They were using simple moving averages. And all those guys and a few girls are now managing the funds. They're all right at the top of the chain now. So they probably still do things the old-fashioned way. So I quite like that. Aussie Sing. Okay, Aussie Sing again, you can see it's starting to creep to the upside here. So I think undoubtedly, just like GBP pairs were sliding a little bit and the Swissy pairs are all going down and all the yen pairs are going up a bit, all the Aussie pairs are going up. There's no doubt about it. The Aussie is the strongest of the majors right now, aside from the dollar. Like the dollar, if it wanted to move, it would move everything else. But right now we exclude that. But out of euro, pound, yen, CAD, Swissy, I think the Aussie is probably the most attractive to me for those things. Kiwi Swissy, just a nightmare. You can't trade that. It's garbage. Kiwi CAD, you can't trade that. It's garbage. And CAD Sissy. And our job, guys, our job is not to try to take a market that's doing nothing and then go, oh, it's going to do something this week. That's not how we make money. We find something that is moving, that has direction, that has purpose this week, and we capture a piece of it. Next week, we find whatever's moving next week and we capture a piece of that. We're traders. We're not investing. It's not the same thing. Cool. Okay, so let's move on to gold and silver. Okay, long story short, we actually know all the levels here. This is beautiful. It's a beautiful thing. It's a beautiful thing. The reason I have two indicators here is just for double confirmation. That's all. You don't need both. You can use one, and you're really only using it to measure momentum. That's all. For convergence and divergence. Okay, so let's have a look at this. Monthly's going up. It's parabolic. What does that mean? It means that the angle of it is now going straight up. Parabolic moves always end with a sharp correction when they burst, when they do. So the reason we know this isn't over is because, first of all, when we had this correction here, it immediately regrouped and is carrying back up. Whereas if the bubble had burst, we would have had a big red candle here instead. So this bubble isn't done yet. And also, the reason for the whole bubble, the geopolitical uncertainty, is getting worse. It's getting more, not less. So this isn't going anywhere. So I want you now to get into your head the possibility of $6,000, $7,000 an ounce, $9,000 an ounce. I want you to get ridiculous numbers in your head now, because that is a possibility in a bubble. This is fear driven. It's also a bit of mania driven. Mania is when as a group we don't think clearly or rationally anymore. Nobody now is thinking, well, $5,200 an ounce for gold is ridiculous. They're not thinking that. They're going, I just need more gold because I don't know what's going on with the dollar. So none of this is rational. And when it's not rational, it breaks all the rules. It breaks them. But what we do know is it continues to look bullish, looking at these candles. Look at your beautiful moving averages. Beautiful. So the question is this, actually. Can we make money until the bubble bursts? And yes, but what will destroy you is if you don't have a stop loss in place. So first of all, whenever you take a buy position on this, you don't short it. Good Lord, you do not short this. This is a bubble. It's going the other way. It could go up for 2 more years. And as it goes up, this is why you don't short it. It's going to accelerate, which means it's going to go up faster. Okay, it's going to go up faster and further. So if you're shorting this, you are done. It will destroy you. So, and the bubble's not burst yet. So right now the question is, should we keep trading it, or should we just leave it alone entirely? So you can trade it, but you must have a stop loss. Why? Well, because, Murphy's Law says that one trade you eventually decide, you wait and you wait and you wait, and eventually decide to get in, and that is the very last move in the market. So you've always got that stop loss somewhere where the furthest my stop loss would be now on any trade would be here. That's the furthest one because, yeah, if we broke that, we're in trouble. But, it might be here as well. And so for me, when I'm taking trades here, it could keep going for a month, 2 months, 6 months, a year, could, but I'm always prepared that maybe today will be the last time. So my entry and my stop loss and my take profit are always just there, and I'm just taking pieces of it. But what we do know for now is that the daily is trending up, looks very nice. You've got your 200, 50, 20, and 10. We really don't need this. I'm just going to get rid of it. It's very distracting. But these are all in the nice, correct order. We've got a beautiful uptrend here. The price action is looking relatively bullish. If you go to the 4-hourly and you zoom out, you could see that nice level there. Nice, multiple touches there. So 5594, basically $5,600 is really the top. We appear to be working our way back up to that now. And we just broke up to this beautiful, my guys would know this, that beautiful, I hope you guys saw this, nice little ascending triangle. I put it in the group, so I hope you guys saw this stuff. And what are we looking for now? We are looking for basically pullbacks as we go. That's what we're looking for. Now, is it guaranteed that it's going to go from here to there? It's not guaranteed. I think it's very, very likely. Like I think it's 85% likely. We could have something like this happen. We could have it do this and then sit here for a bit and then carry on up. That could happen. So there's various ways in which it could unfold. I just, again, like I said, I think at the very least, we have a very good chance that it's going to work its way up here, which means the 1 hour this week, any pullbacks on the 1 hour, 4 hour are potential buy opportunities for day traders. Yes. So again, I love your questions, by the way, guys. When we trade using the daily wave rider, which I stand by is still the best daily indicator I've ever seen, but anyway, do we hold the trade until either the take profit or stop loss is hit? So my mentor would say, generally, if you hold your position until either your first target, one-to-one target is hit or your stop loss. Like until one of those two is hit, you should just leave it. But let me give you a scenario where I might reconsider that, but it's very rare. It's very rare. So basically, the short answer to your thing is you hold it until either your one-to-one target is hit or your stop loss is hit. But I was saying to you earlier that maybe you should consider taking a bit of money off the table at 0.5 to 1, so when you're halfway to your target. But let's imagine we saw a scene like this. So let's just say we'll do it this way. We'll do it on the actual thing, and then I'll come back to the rest of your question. So let's say Uh, I got in on the break here, and my stop loss is here. Could have been there, it doesn't matter. So my one-to-one is going to be there, about there. And maybe I think there's a possibility it can go as far as this. Okay, so this is not just to do with, thanks, Sam. We're going to run over by about 5 minutes. Not much longer, but just letting you know. Um, but with the Wave Rider, for example, I think it is one-to-one for the most part, and that's very good because what they're doing is you're trying to make money on volume, and actually that's the smart thing to do when you're first getting started. But if this was the case, then I might these days sometimes take a little bit of money off the table here and move my stop loss from there to like there. And then if I can, especially if this happens to do this, if it does maybe start to come down and then go up, then I would take my stop loss from here and then like, okay, and then move it there. And so I'm constantly protecting what I have. So that would be the short answer to that. Um, Ultimately, and your next part of that question was, do we close after a few days? I would say no. I would say leave that part out. It is a good question. It's not a silly question. It's a really good question. But no, generally speaking, your market might stall for a bit and then just carry on. So it's more about price. Generally, the market's more about price. This is not a completely ridiculous idea, but I don't think you should use it as a consistent rule. So I'm rather going to say as a consistent rule, just leave it open. However, if there's a big news event like an election or an interest rate change or a rate change or something really, really, really high impact that doesn't happen very often coming up and you're in the money, then you might want to move your entry to your stop loss to your entry or take defensive measures or maybe make the call. Maybe Friday's coming up and you don't know if another war is going to get started. So you're like, you know what? I'm just going to close it out. That is also acceptable. But guys, when you make decisions, there must just always be a rational reason for it. And it's okay if the markets afterwards goes again, like in other words, if you left money on the table, that's always okay. Just make sure that like if you're regularly leaving money on the table, like you're like, you know what, 5 of my last 10 trades went on to make more money, then you want to revisit that. But if on one trade or 1 in 20 that happens, it's not you, it's fine. It's okay. Do we shift our stop loss? Okay, I think I answered that. If gold is 80% uptrend, does it mean Aussie dollar will follow suit? That's a really good question. I think it's benefiting from it, but I don't think you could expect the moves to be as strong. Yeah, it's definitely going the same way, but don't expect it to correlate with the strength of the move here. Another tip, guys, is if you're not seeing something in the charts, then it's not happening. What I mean by that is if a classic example was that gold is a hedge against inflation. That's a urban myth. that people say. Now, in many ways, if you're a vampire and you can live for centuries, then yes, over 30, 40 years, gold can continue while the value of your currency, not just the dollar, but the British pound, the European, the euro, the Singapore dollar, they all devalue over time. That's just normal. That's what happens. So yeah, sure, then gold increases its value, but it can go down for 20 years. Gold can go down for 20 years. It can go sideways for 10 years. So it isn't straight, it's not a straightforward thing. Even in the past, when we had patches here, like here, that was when the dollar went nuts because that was when Russia invaded Ukraine. And at that point, there was a different administration, which was much more stable. And then the world wasn't worried about gold. They weren't worried about geopolitical uncertainty. So in that moment, not in the same way they are now, in that moment, they just moved towards gold. They moved towards the US dollar. They chose the US dollar. Nowadays, it's a very different thing. They're moving away from the US dollar. All right, guys, let's do the last bit before I get cut off. Quickly having a look at silver. So silver's the same. Okay, silver is the same thing. We're expecting this to continue to move up. Same thing again. Silver is generally mostly as bullish as gold, but not exactly. It's 80% correlated, meaning it can be choppy and it can stall and stumble while gold keeps going. So don't expect it to match gold move for move. Crude oil is what I mean when I say this is choppy, right? The longer term trend is to the downside, but it used to trend. Crude oil used to trend a lot more than it does now. And I think in many ways, because we are moving our lives away from crude oil, in many ways, we're losing interest in it. And so speculators are leaving crude oil. They don't really care about it as much. Anyway. All right, guys, next one. So I'm not a fan of it. I would just leave it. But it does look shorter term like it's kind of bullish. Does look like it's got a level here of resistance and support. And the next level is up here. So if it does manage to break through this, it's going to try to work its way up towards $78. But it could still find rejection and end up going back down to these lows. Okay, so it's in a weird fork in the road. Okay, the Dow. All right, I need 5 minutes for this. Can I get 5 minutes for this? Is that okay? Oh, that's actually not so bad. We'll be over by we'll be fine. Okay, first of all, notice again the prickliness. Notice the wicks here and the wicks there, the general prickliness. So you saw in the currency markets, you're seeing it here. This is the Trump effect. He's just making everyone on edge and crazy, making everyone else crazy. And so that's what this is. When you see this happening, it's you can see that it's generally moving up, but you can see this wishy-washy. And so again, I think speculators are leaving the US indices. They're not trading it the same way. Investors are, because of the tax cuts, corporate tax cuts, and various other things. I think the market is still climbing. So if you're holding a position on your stock portfolio, the markets are still bullish. But swing traders are gone because you can't trade a daily market like this. You can't trade that. And this used to be one of the best in the world, guys, to trade. Used to be one of the best. If you just go out and you go back, this used to be one of the best markets in the world to trade because it was very consistent, but it's not there now. Okay. So I think that swing traders and day traders are done. Like they're not in here anymore at all. Now, are we in a bull market? Yes, we are. This is our final monthly candle. That's a bit of a gravestone doji, and you can see the wicks building up here. So this market is stalling a bit, but if you look at previous moves, you can go this far before you kind of have a bit of a correction. And we might just, look, I want you to be prepared for this. We could come down for 2 months and then back up 3 months later. Even if you're hearing all the stuff about jobs and stuff. First of all, you've got to understand something, right? Mutual funds and pension funds, they've got everyone's retirement savings. Where are they going to put it? They're going to put it in the stock market. Where else are they going to put it? They've got nowhere else to really put it. So they're going to put it into the market. So it's probably going to stay there regardless. So that's most of people's money. And people's houses and bond markets and stuff, they're probably going to stay where they are for the most part. And where does all the wealthy people's money, where does all the really rich people's money reside? It's in the stock markets. So, and they, and generally speaking, they just got all their tax cuts and they're going to be cutting rates. So for those people who aren't worried about working, having a job, and aren't worried about a lot of stuff, all they worry about is where does their money earn interest? Where does it get growth? That's all they worry about. And so right now, I think for the most part, they're still happy to leave it here. They are not leaving yet. So how will we know when the really big money is starting to leave the market? When you start to see stuff like this on the monthly, guys, when you start to see that, we're not seeing it yet, but we are seeing some exhaustion come in. So yes, in the next 1 or 2 months, I expect to see a little bit of a correction. But the weekly is starting to stumble and it's very like it's also very messy. So there's no doubt that the US indices are not doing as well as non-US indices. So let's have a look at that. S&P. So I was asked about the S&P as well. Look at this from a monthly perspective. Last 4 or 5 months, not really going anywhere. Lots of wicks underneath. That's a bit of a hanging man. All of those are just really signs of kind of struggle. Not to say that the buyers aren't there, but there's not enough buyers to push it further. So it probably means it's balanced between buyers having enough appetite. They've got enough risk right now. They don't want to buy anymore. They're not selling yet though. Okay, so it's a bit of a holding pattern. I'm going to go to this. What you really should pay attention to is just this part here. It's been going sideways for multiple weeks. Okay. Finally, we're left with the NASDAQ. Now, I want to bring this to your attention because this is really the most important thing. The levels they're standing on, I want you to pay attention to, which is going to be worst case scenario, it's going to be 23. It's going to be the low of this, but it's probably also going to be about there. So this area is really the area you want to pay most attention to. First of all, the monthly. From a monthly perspective, guys, if you look here, we go up, we pull back, we go up, pull back a bit, go up sideways, we dropped a bit, push back up, went up a bit, then the tariffs came out, dropped down and pulled up again. And you forget what these were. What caused that? What caused that? You forget. And believe it or not, at some point a few years from now, we're going to forget what caused this. But this part here, in many ways, is very similar to whatever we've had in the past, where you get these little pullbacks like that. It's very similar. So the only reason I'm telling you this is that where we are now, because we've come back here and then we take off, and we come back here and we take off, just if it happens, you don't be surprised. Don't say you weren't warned. You could end up with the market dropping this month, because this is now a new month, that's February, this is March, and then closing up here is a nice green strong candle, meaning that you got a similar setup here and then it breaks and carries on up. Okay, that could really, really happen. Okay, there's another reason for it as well. If you zoom out, this is what's called a V-shaped recovery there. So you have a V drop, which was COVID, and then you get the subsequent injection of PPE loans and money going into it. Then you get tariffs. This is a V-shaped recovery. And then what you're looking for is, will we get a similar move here? So if we do, we've still got more upside. We've still got more upside if it does a similar type of move. Now, yes, AI is the impact of AI is yet to be, it's going to be dramatic. It's going to be like the car versus, electricity, the car versus horses and carriages. It's going to transform everything. But there's going to be amazing transformations, like in the medical area, identifying cancers and finding cures a lot faster, tumors, incredible stuff. And there's going to be some bad stuff. Okay, people are going to lose jobs, but also surveillance state stuff, like weapons, like there's some scary stuff there. Okay, anyhow, it's good and bad. So just be aware it's stuck in a holding pattern right now. It's trying to understand. It's basically just not doing anything. If it breaks below here, breaks below the 50, then we have something similar to this where we're going to have a bigger correction. But if it can hold above this and it can finish the month, so what you're going to have to do, guys, you're going to have to just look at the monthly and the weekly, to really get a big picture of what's happening. If we end up with a strong bullish candle here for March, it's likely that if April breaks the high, it's going to go up. That's a possibility. It could go sideways. If we end up breaking the low on the weekly, we could end up with a bit of a correction. But you must understand the history of this, guys, is that it goes up. So you never really short the market. Again, it's also suicide. It's made up of the strongest companies. Okay, so in order for this to really have a big correction, you'd have to have systemic failure. Systemic. Yes, we're going to have a correction, but we're always going to have corrections in the future. We're going to have crashes and corrections. We're always going to have that. So, and if you go on YouTube, there's always somebody who's saying it's going to happen now, it's going to happen now, always. And the reason you know they're a scam artist is because when times are good, you never hear them going, you know what, I'm relaxed now, everything's fine, it's okay, you can buy. They're always doom and gloom because that's how they make money. So that's how you know they're not the real deal. And they'll talk about inverted yields and they'll talk about all kinds of stuff in QE and printing and the Fed is doing this and they'll list all these things. but usually they're just manipulating just garbage stuff. So ignore that. Until you see it in the chart, it's not happening. And understand that this thing is designed to win. They've still got the ability to cut rates further. They can still print money. The Fed can still step in and stop stuff if things are going to start to collapse. They have all the tools at their availability. Okay, because we're running over a bit here. But watch what happens when you leave the US. Watch what happens. So 2 years ago, I never would have said to you that the US, I would always have said to you up until about 2 years ago that the US indices are the best to trade. Forget about anything else. Don't worry about anything else. Now I'm telling you the opposite. Forget about the US markets for the time being. Watch them, but don't trade them. But look at this. When you step outside, look at this. Look at the FTSE. It's on fire. It's doing incredibly well. Not just that. Look at the ASX in Australia. Also here, going to all-time highs. These markets are nice and bullish. They're optimistic. They're optimistic. Okay. Um, this is so back to the FTSE looks amazing. There's our daily chart. Any pullback here for me is a buying opportunity. The momentum is nice and bullish. All of this looks really good. The DAX is a little bit more choppy, but mainly that's because it had an insane run. It's a bit of a breather, but it's still pushing up and still look at the moving averages. It's taken a nice 6, 7 month breather. This is what the US markets could end up doing. Just doing this, and then, they could take off. The Nikkei is a bit overextended. This one at some point is going to have to come back, but that might, it's also gone parabolic. There's another example of a parabolic chart just going zhup. So when this has a correction, it's probably going to find itself coming back down more like towards the 20 and 50. But again, I mean, it's having one of the best periods it's had in absolute ages. The markets are very optimistic and quite bullish. HK. All right, this one's interesting as well because, it was one of the weaker, slower markets and it's finally turned bullish. It turned bullish because it broke through some kind of key levels here, but also because higher lows, higher highs. 50, 20, and 10 in a bullish formation. Very choppy, but it's going up. And then finally, no, that was it. That was it. That's all of them. Okay, so long story short, look at this beautiful monthly chart. Just beautiful. Pulls back, inside bullish bar, moving up. You go to the daily. Again, ASX for me. Any pullback here for me would be a nice buying opportunity. These ones over here look good. So your wave rider. Guys, the money right now is leaning predominantly gold and silver and the indices. Maybe not the US indices. The best ones would be FTSE, maybe the German one, Nikkei, HK at the bottom of the list, ASX, and any others that you like that you've got there. And then Aussie dollar in terms of currencies, I quite like that at the moment. Maybe the yen pairs, maybe. But again, that's Swiss yen and Aussie yen. I've given you that list. And then just watch the rest, right? There are times when there's not a lot going on, and then there's times when there's a ton. And right now, just everything is waiting for something to happen. But I can tell you this, it's not going to last forever. It's going to get worse before it gets better, but it's not going to last forever. And when we're finally through this, it's going to be good times for a while. That I'm pretty confident of. Got lots of history books here. Guys, I'm going to let you go. I hope you enjoyed that. You can always give feedback. Let Paul know that you like my stuff, that you enjoy my time and company, that you learn stuff from me. You can always do that. And I look forward to seeing you guys when I'm over on your side of the world at some point. And it's always a pleasure. All right. And I will speak to you soon. Oh, Tiamat, that means the world to me, by the way. Thank you. Thank you. Really means the world to me. Guys, I mean that. I love it. Love you too, man. Thank you. Thank you so much. That's why I do this. I like it. I enjoy it. I will speak to you guys soon.